You are in your 20s, single, no money in your bank, not knowing what to do with your life, but always dreamed with a free life and well-deserved rest without working until your 60s? It is possible, and by the time you finish this video, you will know the exact roadmap to retire at 37. Not retire someday, not retire if things go well. Retire at 37, with the specific numbers, the specific accounts, and the specific IRS rules that make it mathematically provable. Here's what this video is actually about. Most personal finance content tells you to max your 401k and invest in index funds. That advice isn't wrong, it's just wildly incomplete, because a single person in their 20s has a set of structural advantages that almost nobody is talking about. Legal tax shelters, IRS loopholes that most accountants have never mentioned to a client. A compounding window so powerful that every dollar you invest right now is worth more than twice what it will be worth if you wait until your 30s. I've spent months going through the 2026 tax code, the contribution limits, the withdrawal rules, and what I found is that the blueprint for retiring at 37 already exists. It's already legal. It's already available to you. Most people just don't know it's there. Here's what we're covering. First, why your 20s are the highest leverage decade of your financial life by a factor that will genuinely shock you. Then the complete 2026 tax advantage stack, the exact accounts, the exact limits, and the exact order to fill them. Then the three strategies most accountants never explain, the mega backdoor Roth, the Roth Conversion Ladder, and the Rule of 55. And finally, the full decade-by-decade withdrawal roadmap that gets a 22-year-old to $717,500 and financial independence by age 37. Let's start with a number that should make you feel something. The median net worth of a person in their 20s right now is $6,600. Not $66,000, not $660,000, $6,600. The average is $139,000, but that number is dragged up by a small group of outliers. The median tells you what the person in the middle actually has, and the person in the middle has less than most people spend on a used car. What that means for you is not that you should feel good about yourself. What it means is that the baseline you're competing against is almost on the floor. The gap between the median 20-something and the top 10%, who have over $520,000, is wider in your 20s than in any other decade of life. And here's the part that almost nobody says out loud. That gap is not determined by inheritance. It is entirely determined by behavior. By whether you know this stuff and act on it, or whether you don't. The average American saves 4.6% of their income. Every single 1% increase in your savings rate shaves 2 to 3 years off your retirement date. If you're watching this, you are already playing a different game than almost everyone around you. But the behavior advantage is only half the story. The other half is time. And the math on time is something most people have heard but almost nobody has actually visualized. Here's the real number. If two people both invest $5,000 a year at 8% returns, the one who starts at 22 ends up with $1,452,259 by age 62. The one who starts at 32 ends up with $619,990. Same amount invested every year. 10-year Head Start produces $832,000 more, despite only $50,000 more in actual contributions. Think about that ratio. You put in $50,000 extra, you get $832,000 extra back. That's not a typo. At 8% returns, every dollar you invest in your 20s compounds to roughly $16.60 by age 62. The same dollar invested in your 30s only compounds to about $7.10. Your 20s are not just slightly more valuable than your 30s. They are more than twice as powerful, dollar for dollar. And most people spend them either not investing at all or investing a fraction of what they could. If you invest $500 a month starting at 22 at 7% returns, you end up with $2,395,700 by age 62. If you start at 32, same $500 a month, same 7%, you end up with $1,198,400. The decade of delay cost you $1,197,300. Not because you did anything wrong, just because you waited. That's the foundation. That's why this matters. But knowing that time is your greatest asset doesn't tell you what to do with it. So let's talk about where to put the money. Because this is where most 20-somethings leave enormous amounts of value on the table. Most people think max out your 401k is the complete plan. It is not even close. Here is the full legal tax advantage stack available to a single person in 2026. Your 401k employee contribution limit is $24,500. Your Roth IRA limit is $7,500. Your HSA health savings account, Self-only limit is $4,300. Your healthcare FSA is $3,400. Total, $39,700 per year that the IRS allows you to shelter from taxes. Almost nobody knows that number. Almost nobody is hitting it. And here's something about the Roth IRA that almost no 20-something gets told. Your contributions, not the earnings, but the money you actually put in, can be withdrawn at any time for any reason, with zero taxes and zero penalties. That means your Roth IRA is not just a retirement account. It is also your emergency fund for the principal. You can invest it, let it grow, and know that if something catastrophic happens, the money you put in is accessible. That changes the calculus entirely for someone who's worried about locking money away until 59 and a half. Fill the 401k first up to the employer match. That's a 100% instant return on your money. Then the HSA, then the Roth IRA, then back to the 401k up to the full $24,500. That is the order. That is the stack. But here's where it gets interesting, because if you work at the right employer, there's a strategy that blows all of this wide open. It's called the Mega Backdoor Roth, and it is the most powerful, least known strategy in personal finance for someone in their 20s. Here's how it works. The total 401k bucket in 2026, from all sources combined, is $72,000. The standard employee contribution only fills $24,500 of that. Your employer match fills a bit more. But if your employer allows after-tax contributions to your 401k and in-service withdrawals or in-plan conversions, and some of the biggest employers in the country do, including Google, Microsoft, Amazon, Meta, Apple, and Nvidia, you can fill the remaining space with after-tax dollars and immediately convert them to a Roth. Let's run the actual math. You earn $100,000. You contribute $24,500 to your 401k. Your employer matches 4%, adding $4,000. That leaves $43,500 of unused space in the $72,000 bucket. You contribute $43,500 in after-tax dollars and immediately convert it to Roth. Add your $7,500 Roth IRA contribution. You now have $51,000 going into Roth accounts in a single year. At 7% over 30 years, that 1 year of contributions grows to over $388,000, entirely tax-free. If you work at one of those employers in your 20s and you don't know this exists, you are leaving life-changing money on the table. Not a little money, life-changing money. Now, what if you earn too much for a regular Roth IRA? The income phase-out for single filers in 2026 starts at $150,000. A lot of people in tech or finance hit that number early, and most content just says, you can't do a Roth IRA. That is wrong. You use the Backdoor Roth. You contribute to a traditional IRA. There's no income limit for contributions, only for deductions, and then you immediately convert it to a Roth. The limit is still $7,500. It's a two-step process, not a loophole. It's completely legal, and the IRS has explicitly said it's fine. But here's the trap that almost nobody explains. It's called the pro rata rule. If you have any pre-tax money sitting in a traditional IRA, the IRS doesn't let you convert just the after-tax portion. It treats the conversion as a proportional mix of everything you have across all your traditional IRAs. So if you have $93,500 in a traditional IRA and you add $7,500 after tax, only about 7.4% of your conversion is tax-free. The rest is taxable. The solution: before you do the backdoor conversion, roll all your pre-tax IRA money into your employer's 401k. Most 401k plans accept incoming rollovers. Once your traditional IRA is at zero, you do the backdoor conversion cleanly. Zero pre-tax dollars, zero pro rata problem. Almost no article on the Backdoor Roth explains this step in plain English. Now you know it. That's important. But there's another tax advantage that almost nobody in their 20s knows about, and you can use it years before retirement. For 2026, single filers pay 0% in federal long-term capital gains tax on income up to $49,450 of taxable income. The standard deduction for single filers is $16,100. That means you can have gross income, wages plus investment gains up to about $65,550 before you owe a single dollar of capital gains tax. Here's the move. In a year when your income is lower, new grad year, a sabbatical, a freelance slow year, any year where your taxable income is below that threshold, you sell appreciated index fund shares from your taxable brokerage account. You pocket the gains, you pay zero federal tax, and then you immediately buy the same fund back. This is called tax gain harvesting, and what it does is permanently reset your cost basis to the current price. Every dollar of future gain you just eliminated is a dollar you will never owe taxes on again. You're not avoiding the tax, you're legally eliminating it while the window is open. Here's a concrete example. You earn $45,000. After the standard deduction, your taxable income is $28,900. You have $20,550 of headroom before you hit the 0% cap gain ceiling. You sell $20,550 of appreciated index fund shares. Zero federal capital gains tax. You buy them right back. Your basis is now reset. That gain is gone from the IRS's perspective forever. Use every low-income year you have in your 20s to do this. Every single one. Now let's talk about the withdrawal side, because getting to a big number is only half the problem. The other half is getting the money out without paying a 10% penalty before age 59 and a half. This is where the Roth Conversion Ladder comes in, and this is the mechanism that makes early retirement mathematically possible. Here's how it works. You retire at, say, 45. You have $800,000 in a traditional IRA or 401k and $200,000 in a taxable brokerage account. You can't touch the IRA without penalties until 59 and a half, unless you use the ladder. Each year you convert a chunk of your traditional IRA to a Roth IRA. For 2026 single filers, the 12% tax bracket tops out at $50,400 of taxable income. After the standard deduction, you can convert about $34,300 per year and stay entirely in the 12% bracket. Your effective tax rate on that conversion is around 6 to 8%. You pay the tax now from your brokerage account. Each conversion batch has its own 5-year clock. Wait 5 years, and that converted money is accessible penalty-free at any age. So years 1 through 5, you live off your taxable brokerage. Year 6, your first conversion batch matures. You now have penalty-free access to retirement funds at 50, having retired at 45. The ladder requires planning 5 years in advance. That's it. And the math works at a surprisingly low tax cost because you're controlling your income in retirement, which means you're controlling your tax bracket. But there's one more piece to the withdrawal puzzle that almost nobody in their 20s thinks about, and it's worth building into your plan right now. It's called the Rule of 55. If you separate from your employer, for any reason, including voluntary resignation, in the year you turn 55 or later, the IRS waives the 10% early withdrawal penalty on distributions from that employer's 401k. You still owe income tax on the withdrawals, but the penalty disappears entirely. There's one critical trap. This rule only applies to the 401k of your most recent employer. If you roll that money into an IRA, you lose the Rule of 55 access and you're back to waiting until 59 and a half. So the play is, keep your final employer's 401k exactly where it is at age 55. Don't roll it. What this creates is a clean 3-phase withdrawal strategy. From early retirement to 55, you use your taxable brokerage and the Roth Conversion Ladder. At 55, the Rule of 55 unlocks your 401k penalty-free. At 59 and a half, everything else opens up. At 65, Medicare kicks in, which eliminates what is genuinely the hardest cost to plan for in early retirement. 3 phases, clean transitions, no penalties, and then there's the HSA, which is, without question, the single most underused account in the tax code for a healthy person in their 20s. The HSA is triple tax advantaged. Contributions go in pre-tax. Growth is tax-free. Withdrawals for qualified medical expenses are tax-free. No other account does all 3. And unlike a 401k, there are no required minimum distributions. The money can sit and compound indefinitely. Here's the move almost nobody talks about. If you're healthy and can afford to pay your current medical expenses out of pocket, don't touch the HSA. Let it grow. Save every single receipt. There is no time limit on HSA reimbursements. A receipt from a doctor's visit you had at 24 can be reimbursed tax-free when you're 54. You're essentially creating a tax-free slush fund that you can tap at any point in retirement by matching it to old medical receipts. The math on a 22-year-old maxing their HSA at $4,300 per year at 7% returns. By age 30, you have $53,000. By 40, $146,000. By 50, $323,000. By 65, $754,000, entirely tax-free for medical expenses. And after 65, you can withdraw it for anything and just pay ordinary income tax, same as a 401k. It becomes a second retirement account with no strings attached. Now let's put the whole thing together. You are 22. You earn $65,000. You invest $24,500 in your 401k, $7,500 in your Roth IRA, and $4,300 in your HSA. Total invested, $36,300 per year. That's a 55.8% savings rate on a $65,000 salary. Your annual spending is $28,700, modest but completely livable in a low cost of living city with no car payment and no lifestyle inflation. Your FIRE number, the portfolio size where a 4% annual withdrawal covers your expenses indefinitely, is $28,700 times 25. That equals $717,500. At 7% real returns, investing $36,300 per year starting from zero, you hit $717,500 at approximately age 37, 15 years. From zero to financially independent in 15 years on a $65,000 salary, using accounts and rules that already exist and are already legal. And here's the part that almost nobody says. Being a single person in your 20s is not a disadvantage in this math. It is a structural advantage. Your FIRE number is roughly half what a couple needs. You have one set of expenses, maximum geographic flexibility, one plane ticket, one lease, no school districts, no childcare costs, which average $28,000 per year for a family. You can move to a lower cost city tomorrow if you want to. You can take a higher paying job in a different state. You can house hack, geo arbitrage, or just quietly optimize in a way that a family of four simply cannot. The most successful people who reach financial independence early are not the ones who quit everything and never work again at 35. They're the ones who hit the number and then have the freedom to choose, to work on their terms, to take risks, to say no to things that don't matter. That's what $717,500 buys you. Not a life of doing nothing, a life where you are never financially forced to do anything. If you made it this far, you already know more about this than most people will learn in their entire adult lives. If you want to go deeper on any single piece of this, the Mega Backdoor Roth, the Conversion Ladder, how to actually pick index funds for each of these accounts, drop it in the comments. I read every one and the most requested topics become the next video. And if this was useful, share it with one person in their 20s who needs to hear it. Not because it helps the channel, though it does, but because this information has a compounding effect too. The earlier someone gets it, the more it changes. Subscribe if you want the rest of the blueprint, because the accounts are just the foundation. The next piece is how to actually invest inside them, and that's where most people make the mistake that quietly costs them hundreds of thousands of dollars over a lifetime. You now have the roadmap. The only question is whether you use it.